All right, what's up traders? This is Hugo. So today we're going to talk about a little cheat code or a clarification on bid and ask prices on an option. When you start getting into more complicated strategies where you have several options, a straddle or even a spread, a credit spread where you're buying a put and then selling a put, the price that Robinhood puts on the screen is not the correct price or the actual market price. And this is the same across a lot of brokerage firms. So what I'm going to do today is I'm going to give you a real life example. I'm currently trading a credit spread on O'Reilly Auto Parts. I think it's a phenomenal stock. I get a little bit more into detail a little bit later in the video, but the specific things that I'm going to teach you is what are the dangers of opening a credit spread or selling an option on a stock that does not have much liquidity. You can get caught very easily if you're trying to jump out of the option, you're trying to buy it back so you can close it out. It may be a little bit more difficult. The price fluctuates a lot. And so you have to really understand and look at the bid and ask price, depending if you bought it or you sold it, to get to the true price of where that option is. Because as you're going to see in the video, it completely distorts what your actual profit is or what your actual account balance is, right? And if you were to act on that balance, it may cause you to make a decision that is not true, right? And the other great thing about understanding these bid asks is that it enables you to really put in an offer to open an option or to sell an option that is at the market. You don't leave any money on the table, and it also allows you to close out an option at the cheapest possible price, so that way you're not paying for an option that is overpriced and is going to leave you at a loss. All right, so pay close attention to this example. I think it covers everything that we need to know about how to hack the bid and ask price to give you the true price of the option. Please don't forget to subscribe and like if you like this content, and let me know in the comments if you have any suggestions or anything that you would like to cover in detail. I wanted to show you personally on my Robinhood how the bid and ask can be a bit not very honest, and you have to be able to understand it and look at it in detail in order to be able to open options properly and not leave money on the table. And number two, be able to close them properly and be able to capture as much of the profit as you can. And a very good example is the current trade that I have right now for O'Reilly. So O'Reilly is a very interesting stock, right? Because it has a very large institutional ownership, which means that a lot of hedge funds and a lot of ETFs own the stock. This usually means that there's low volatility, right? Because these hedge funds and ETFs, and mutual funds, they don't really sell and buy frequently. So it means that the stock is usually pretty stable, which is what we want. And so if you go ahead and look at O'Reilly, I sold these calls on Monday of last week. And I usually sell weeklies, which means that the option contract expires in a week. These are monthlies. And I did the monthlies because of the turbulent week that we had last week with the Fed announcements and the housing numbers. And I wanted to give myself the month and give the option the month to correct if it needed to, or to be able to have a little bit of wiggle room, right? So I want to show you this in detail. So if we go over to O'Reilly, O'Reilly's trading at 688 right now. If you look at the 5-year chart, we have a 52-week high of $750. That means that the all-time high that this thing has reached is $750. So my rationale was, what are the odds that this company is going to break through its all-time highs given the situation we have economically right now? We have a war in Ukraine. We have the British pound at its weakest point in a very long time. We are on the brink of almost nuclear war. Inflation is going through the roof. So the odds of it going through to 750 are very low. So I went ahead and sold a credit spread for $760. So that means that I'm okay, I'm in the green, as long as the stock remains below $760. Right now it's at $688, so I am doing very well. And so what I'm usually going to do is close this monthly a little early. I'm probably not going to wait till the end of the month, though you can. So looking at some quick details here, we have the average credit I got for it. So I got about $79 per contract. And each contract required $1,000 of collateral. So if we do 760 minus 770, that gives us $10. So that's how much collateral the stock market requires us to put up, $10 per share. Now remember, option contracts are 100 shares, so that means that's $1,000. So for every option credit, you have to put $1,000 of collateral. Okay? So, and for every option you sell, you get $80. So you're pretty much putting on hold 1,000 to receive 80. Now, if you look at that on pure return metrics, you've got $80 divided by 1,000. Okay, and if we were to multiply that by 100 to get our percentage, we're collecting about 8%. So 8% in a month for something that has very low odds, I think is a phenomenal trade. So having said that, I want to really dive into the bid and ask and what I want to show you here with the market. So as you can see, the option chain of the 760.77 call credit spread has been extremely volatile. If we look at the week, it's reached a low of 8 cents. It's reached a high of $235 per contract. So this option chain is all over the place. And the reason for it is because the spread, meaning the difference between what people are willing to pay for it and people are willing to buy it for, has been very large. And so what Robinhood does, and a lot of other brokerage firms are, is that they take the number right in the middle. So they say if somebody's offering $5 and another person $5 to buy it, and a person is offering $15 to sell it, the system's going to show you 10. And that 10 is really not realistic, because if you were going to try to buy it for 10, you're not going to get it because the person that's willing to sell it is at 5. So that's why you have to be very careful with the bid and ask, and I'm about to show you how you can see that. I wanted to go over some of the basics in reading the bid and ask and how it usually relates to liquidity. So going back to the O'Reilly position that we have here, I'm going to show you this position. Now this is a more advanced strategy, the credit spread. I'll show you also the bid and ask on a simple either call or sell. So when we go down here, right, we have to go into each individual option. So this particular strategy is buying calls and selling a call. So if we go into the call that we sold, we see all the key information here. So for this particular option, it's trading at 228. We received a credit of 299. So that's why it's showing that we are up on this particular option. Now these statistics are the ones I wanted to get a little bit more clarity on. So we have the bid, which is what people are bidding on the option for, so what they're willing to pay. So we have about 11 open bids for 55 cents. And the ask is what people are willing to sell for. That's what they're asking for. So we have an 11 for $4. Now, when we have a spread of this magnitude, it's a very clear sign that there's not much liquidity in this option, right? And that can be dangerous if you are looking to exit this spread, because that means that you're gonna have to pay the ask if you really want to close it, right? And so if you look at the ask versus the credit that we got, it makes absolutely no sense, because that means in order to close it, you have to do the opposite of whatever the strategy is. So for this particular option, right, and this is part of a 2-option strategy, the spread, but for this particular option, since I sold it, if I want to close it, I would have to buy it, right? And Robinhood kind of gives you this already. It says buy to close or sell to open the position. So to close it, I would have to buy it back at $4, which at this point does not make any sense. So I would not close it. Now, 243 tells you what the high of today was. So the $2.43 was the highest it's traded at. Volume, so the volume tells you how many of those contracts traded today. So just counting the trading days. So there was only one contract traded. And the open interest generally just tells you how many of these contracts are open in the market. So it tallies up all the buys and sells and tells you how many are open in the market. So 63, very low. Usually, as a rule of thumb, you want to look at an open interest of 100 and above. And so this is what this tells you, right? So if I wanted to close this particular strategy, and again, this is a credit spread, a call credit spread. I have another video that gets into detail on what a call credit spread is and how you can profit from it. It is probably one of the most profitable strategies that I've had. So if I wanted to close this particular strategy, right, if I go to the actual option chain, right, which tells me the whole strategy, it tells me that currently it's valued at 65, right? So that's what Robinhood is telling me. But if you look a little bit closer, right, we go to the call. This one I would have to buy to close. So I'm going to look at the ask price. The ask price right now is $4. And then we jump over to the other position, which is the option that we bought, right? So again, it says buy to open, sell to close. So since we bought this one for 220, we would have to sell it to close. And so we go down here, and since we have to sell it, we are looking at what people are willing to pay for it. So now we're going to be looking at the bid. So we've got the $4 and then the 30 cents. So $3.70 is what you would need to buy this whole strategy back at, or what you would have to pay in order to get it filled, right? Because if you were to just type in 65, which is what it tells you here, and put in an order, it would not fill. It would not fill because the true price is the $3.70. If you were to type in $3.70 here, then yes, it would be filled. But why would you pay $3.70 when you got 80 back, right? So the strategy that I do is I put in a limit price of what I feel comfortable selling it at. So I would put it at 1, and then this I would put at 25, and perhaps it won't get filled until we get closer to the expiration date. Because remember, as we get closer to October 21st, the value of the option itself is going to lose more and more and more value. And that is, of course, if the price remains below the 760. So that is what I wanted to show you. That is how you're able to hack the bid and ask price to tell you exactly what it is that you can get for that option, or what you have to pay for that option. And you can use this to make sure that you input the most profitable offer to open an option and the most profitable offer to close an option. So you have two options. You can either hold this till expiration, right? At expiration, they both expire worthless. So that means that you return 0 credit. You keep 100% of the premium. So you keep 100% of the 1736 that we received. This 1736 is essentially this credit per the amount of contracts that I have. So $79 times 22 will give you the 1736. You can do that. Or what I like to do is, because it's so volatile and at times it does reach the price that I want to sell it at, I'm okay closing this for 70% premium capture, right? So when my total return says plus 75%, I'm okay with closing this. So I'm going to go ahead and close this position, and I'm going to close only part of it. I don't want to completely get rid of my position. I'm going to close 10. I'm going to put a limit price of 25 cents. So that means that when the stock option reaches this price, it'll go ahead and execute. So you're paying $250 to close it out, right? Because it's not worthless. If you waited till October 21st and the stock was below 760, then this would just be 0 and it would expire worthless. You keep full premium. But because I want to close it out early, I'm going to go ahead and put 25, so I'm paying $250 back. Because remember, you got, for those same 10, you got an average of 79, so you got $790. So now you're going to pay $250 to close it out. So that difference is what you're going to profit. And you would just go ahead and review order. You're going to be paying a debit. It's going to go ahead and release the collateral that you have on there, because since you're closing the option, you no longer need to have that collateral. And then you go ahead and submit the order, right? So right now it's 9:28. We're going to pause this for a second. I want to show you how the market, my account, is going to react to the craziness of this credit spread. You're going to see it in live time. So I'm going to pause this real quick. So right now we're at a $29,231 balance. We are still pre-market. It's 9:29. So let's go ahead and give it a second. Right now we're up slightly. We're up $59, 0.20%. Now remember, options do not have pre-market. Okay, so that means that it's not going to move until the market opens at 9:30. And it is 9:30 a.m. And look at that. We're up $5,400. We are now at almost $34,500 instantly. And that again is due to the volatility of the O'Reilly option chain. So now if we go into the option chain of O'Reilly, it went down 52% now that it opened. O'Reilly's down 687, which is exactly what we want. And right now this is showing me a 200% return, 147% return. This is a $5,000 profit. So what I'm going to do, as we discussed, is I'm going to go ahead and try to close this and put a limit order at 25 cents. That is what I feel comfortable closing this early at. And perhaps it'll reach it during the day. It all depends on the bid and ask. So we're going to go ahead and put a 10 contract to close order. We're going to put the limit price of 25 cents or $25, good for the day. Review available. This is going to be a debit because we're paying the brokerage back. It's going to release my $10,000 in collateral. It's going to sell to close, buy to close. And boom. So right here it tells you kind of a quick summary. So how many have sold right now instantly? 0. And we knew that. Right now it's priced at 55, so we knew it wasn't going to necessarily execute right away. Your cost is $250. We still have 22 contracts. If it goes through, it's going to release $10,000 in collateral, 0 commissions. So you click done and you go about your day. Worst case scenario, it doesn't close. You try again tomorrow. Best case scenario, it closes. You exit a portion of that position. You would still have 12 available and you're all set. So this is really what I wanted to show you guys. Have a great one. I'll see you in the next video. What's up, option traders? This is Hugo with Living with Options. Please like this video and subscribe so I can continue making this content. Thank you. Alright traders, well that's it for today's video. I hope you learned from this O'Reilly example. I think it's a phenomenal example, seeing how the portfolio value went from 29 all the way to 35 in a matter of seconds. That option chain fluctuates a lot. And if you want to be able to close them out properly, or wait till expiration, either one, but usually I like to close them out early, maybe a week or two. I'll talk a little bit more about that specific strategy a little later on. But if you want to close them out, you need to understand the bid and ask price of what it truly is in order to be able to close them out in the most efficient way possible and not leave money on the table. If you learned something today, please like, subscribe. We're going to be putting a lot more content out later. Have a great one, guys. All right, option traders, that's it for today. I hope you learned the hack for the bid and ask price and hope this gets you closer to living with options. Till next one.